So I'm here with Alison Bettonville today, principal at STRAT. She's going to take us through the CARES Act, specifically the CARES withdrawal and CARES loan options. Employers have the option of offering these two features in their plans, and Alison's going to compare and contrast those for us. Employers don't have to offer both. Maybe Alison, you can tell us what are the options and what are sponsors doing?
Great. So the CARES Act allows for each of a special loan and a special withdrawal that can be offered within a qualified retirement plan. And you're absolutely right, Will. Some sponsors are offering both options to employees. Some sponsors are picking one option, and some are not offering these provisions at this time. We're seeing all of those actions really depending on, first and foremost, impacts to the sponsor's workforce. Those employers who really aren't seeing financial impacts and changes in their employment levels or aren't seeing significant caseloads oftentimes aren't choosing to offer these features and wanting to ensure that money is protected for retirement. Other sponsors are choosing to offer just one feature to simplify that choice for participants. And then, of course, others are choosing to offer both features in really making sure that there are employees who are impacted can make a decision between those two choices and recognizing, given degrees of impact, that different choices will be different for different employees.
If my employer offers the CARES withdrawal provision, what are the most important things for me to consider?
So the CARES withdrawal really is intending to provide access to funds for those impacted by the virus. Generally those who are still employed at an organization, even on layoff or furlough, can't access their retirement savings. But under a CARES withdrawal, those impacted by the virus can withdraw up to $100,000 from their plan account. There's no early withdrawal penalty associated with that. So if you're under 59 and a half, that 10% penalty won't apply. And then you've got some flexibility on the taxes. You can either pay the taxes on the withdrawal within 3 years, or you have the option to repay the withdrawn amount within 3 years. And in that case, you'll avoid any income taxes.
Who's eligible to take the CARES withdrawal?
So under the CARES Act, there's a definition of impacted people. That includes anyone who has been diagnosed with the virus, who has a spouse or dependent who's been diagnosed, or those that have suffered financial impacts due to the virus. And the Act calls out specifically those with reduced hours at work, those impacted by a layoff or a furlough, even being out of work because of lack of childcare or due to a quarantine are all called out in the bill as financial impacts of the virus.
And how does one demonstrate the need for this withdrawal?
So actually, the bill doesn't require that you demonstrate a need for the withdrawal. There's a self-certification process where you simply self-certify that you are impacted under the bill in order to take the withdrawal. Now, it's important to keep in mind, even though you're not required to provide documentation at the time of taking the withdrawal, that doesn't mean that the IRS can't come back and audit later. And in the event of an IRS audit, if you're found to have taken a withdrawal under the CARES Act, but really didn't meet that definition of impacted, you could potentially face taxes and penalties.
Most people are familiar with hardship withdrawals in their 401k or 403b plan. What's the difference between this and a CARES withdrawal?
Sure. So you can think of the CARES withdrawal in some respects as a special kind of hardship withdrawal, but much more open than a hardship. So under a hardship withdrawal, you have to meet one of 7 specific criteria, and your withdrawal is limited to the amount that you need to withdraw in order to meet your need. Under the CARES withdrawal, it's a very different definition. There's not a definition of need so much as a definition of impacted by the virus, and you don't have to demonstrate an amount of need or limit your withdrawal to an amount of need.
So if I take a withdrawal, am I allowed to repay that money into the plan?
Yes. So the CARES withdrawal can either be repaid within 3 years of the time it's withdrawn, or you will owe income taxes on that amount. So from a repayment perspective, that would be treated like a rollover, and that repayment can be made to the 401k or 403b plan you withdrew from. It could also be made to another qualified plan or to an IRA account. So you do have some flexibility in how you make that repayment.
Great. And what things should I be considering if I need to take this withdrawal, and how will it impact my retirement savings?
An important consideration certainly is retirement outcome. Certainly in taking money out of your account today, that's going to reduce your savings. It's going to reduce the amount that you have invested. And even if you do intend to make that repayment, you may be missing out on investment earnings between the time of the withdrawal and the ultimate time of repayment. So that will have an impact on your retirement outcome. And then, of course, if you don't make that repayment, that will reduce your overall accumulated savings at retirement much more significantly. There's a lot of great tools and resources out online. Check out your retirement plan administrator or other retirement calculators online. You can do a simulation and say, hey, what's my account balance now? What's my account balance if I take some money out? And look at those different projected retirement balances to get a feeling for that outcome. Now, we certainly recognize, near-term financial needs may really outweigh the ability to plan for retirement right now, but still a good idea to get a sense of what this does mean to your long-term retirement savings.
And I guess it goes without saying, there's a lot of other opportunities to help your financial situation available right now. So this probably would be towards the bottom half of your list if you needed money, correct?
It could be. Certainly, you should consider all avenues of being able to access funds, whether that's some of the other provisions under the CARES Act, the tax rebate check that perhaps you may be eligible to receive, some of the other loans and programs out there, other consumer borrowing options may be available to you. So certainly consider all of your available resources before taking this type of withdrawal.
And what if my employer does not offer a CARES withdrawal?
Right. So this is not a required provision, and we do know a lot of employers that are choosing not to offer this feature. That's generally due to concerns about potential abuse, given that self-certification provision, or just a general belief that most employees aren't facing financial impacts or other impacts due to the virus. Keep in mind the CARES Act and CARES withdrawals do span 2 IRAs. So if you have an IRA and your employer is not offering CARES withdrawals, you could potentially take a CARES withdrawal from your IRA. You could look at other withdrawal options from your plan. If your plan offers loans, that may be available to you. If your plan offers hardship withdrawals and you're experiencing one of the specific hardship situations, that may be another avenue. And certainly talk to your employer. They may be offering some programs outside of the 401k plan or may have other ideas about how you can access funds if you are suffering from a near-term financial situation.
One of the other provisions of the CARES Act allows for participants to take loans. Can you give us the key features of the CARES loan program?
Sure. So a CARES loan offers a little bit broader borrowing ability than a typical retirement plan loan. So in a CARES loan, those impacted by the coronavirus can take a loan for up to 100% of their account balance or up to $100,000. There's some additional flexibility in the CARES Act to delay loan repayments. So repayments otherwise due in 2020 can be delayed for up to a year. That means someone taking one of these CARES loans can take that loan now and then not start repayments until 2021.
And who's eligible for a CARES loan?
Mhm. So the CARES Act outlines those impacted by the virus. That would include anyone who's been diagnosed with the virus, who has a spouse or dependent who's been diagnosed, or who's experiencing a financial impact due to the virus. And the Act outlines reduced hours, layoff, furlough, even being out of work due to lack of childcare or having a quarantine situation, all as potential financial impacts of the virus. And any of those situations would allow someone to potentially qualify for a CARES loan.
And is that a self-certification?
It is. The Act allows self-certification. So that means you don't have to provide documentation or proof at the time that you're taking out the loan. Keep in mind, though, there is potential for audit in the future. The IRS could come back and review that in the future. And if you didn't actually meet that definition of impacted, there could be potential for penalties.
So once I take the loan, what happens to my repayment process? How do I make
Mhm.
repayments?
Sure. So the repayments under a CARES loan would follow a typical loan repayment process. In most plans, that's through payroll, so automatic payroll deductions. Some plans do offer repayments directly from bank accounts. So check with your plan administrator to confirm your process. And those repayments would most likely start in 2021 under the provisions of the CARES Act and then would continue until the loan is paid off.
And what if I don't fully repay the loan? What happens then?
So, in the event that you stop making payments, your loan will become delinquent, and after a period of time, it'll go into default. And at the time of default, the outstanding of the balance of the loan will become taxable to you in that year at your tax rates in the year of the default. And you'll also face the early withdrawal penalty if you're under 59 and a half. So that's an additional 10% tax if that loan does fully go into default.
What if I already have a loan outstanding? How does that impact my ability to get a CARES loan?
That very much will depend on your plan and your plan's provisions. So check with your plan administrator about your ability to take a loan under the CARES Act, particularly if you already have a loan outstanding.
In terms of taking a loan, how does that impact my overall retirement savings?
Sure. So much of that depends on if the loan is repaid. Certainly, if you don't fully repay that loan and have that default situation and you're not repaying that money, that's going to reduce your accumulated retirement savings permanently. If you do repay your loan, you're repaying that with interest. So you've got a little bit of earnings on top of restoring the money that you've borrowed from the plan. But you are missing out on earnings given that that money is out of the market. And then, of course, you're missing earnings on the missed earnings. So overall, those who take loans do accumulate less in retirement savings versus those who don't take loans. We certainly recognize in the current economic environment, lots of folks are dealing with an economic event or a financial impact, and the 401k plan and your account balance may potentially be a reasonable source of funding in order to meet that need. We certainly suggest considering all of your options, though, prior to taking a loan.
If my employer offers both the CARES loan and the CARES withdrawal, compare and contrast both of those for me, and which should I consider taking first or prioritize?
So there's a couple of really important things to think about in comparing the CARES loan and the CARES withdrawal. First, let's talk about taxes. Now, if you're going to repay, whether it's the loan or the withdrawal, your tax impact is going to be the same. You're not going to pay taxes on either of those options. But if you're concerned about your ability to repay in the future, the CARES withdrawal may be more favorable to you, as you definitely will not face that 10% early withdrawal penalty. On the flip side, if you take that CARES loan and default on it, the full amount of the loan will be taxable to you in the year of the default, unlike the CARES withdrawal, where you have some flexibility to spread those taxes over multiple years. Another really important consideration is repayment. If you really want to repay this amount to the plan and limit your impact on your retirement outcomes, while you can make repayments under either option, the loan may be a better choice there. It's going to have a set repayment schedule where repayments will occur regularly, either directly from payroll or directly from your bank account. That makes it way easier to repay that money. Under the CARES withdrawal, well, you can make repayments. It's not a fixed process, and you'll be responsible for setting up those payments and sending them to your retirement plan administrator or other retirement account. And we all know how difficult it can be to remember to make those payments on a regular basis. And then another important consideration is just broad retirement impact. Couple things to keep in mind there. The CARES loan, those repayments do include interest. So while you're paying yourself back with interest, that's going to get you closer to the retirement balance you would have had if you had never taken a withdrawal. With the CARES withdrawal, again, while you can repay that amount, if you don't make that repayment, or if depending on the timing of that repayment, you could be missing out on significant earnings, and that would, of course, reduce your overall accumulated retirement balance. We recognize nobody wants to tap into their retirement savings early, but in times like these of financial stress, may be an important resource in order to be able to meet your everyday living expenses. And you do have flexibility under either option to make repayments and ultimately restore and improve retirement outcomes relative to not repaying those balances at all.
And so it's important to talk with your advisor if you have one, or to contact your plan's record keeper to see what tools and resources they have to help you make those decisions, correct?
Yeah, absolutely. Contact your retirement plan administrator. They can confirm for you the exact features that are available in your plan and the process to take a withdrawal. They can also help you understand the detailed impacts on your account and direct you to even more tools and resources to really help you understand exactly how these actions might impact your retirement readiness.